Welcome back for today's Farm and Ranch News. In our headlines this morning, some news for sugar growers and cooperatives here in the U.S. They're expected to have a stronger financial year ahead with improved production and higher prices for the 2020-21 crop. That's according to a new report by CoBank that said consumer demand for sugar remains high. This comes after last year when weather impacted planting and harvest in Montana and other key producing states, resulting in a shortage of 28.6 million tons of sugar beets. USDA predicts acreage nationwide at 1.13 million acres, up 6,500 from last year. With demand remaining strong and refined sugar supplies tightening, the price of wholesale refined beet sugar has surged to 44 cents per pound, up from 35 cents per pound last fall, and the highest price since 2012. Raw sugar prices, though, have held steady at around 25 to 27 cents per pound over the past 2 years. Now, speaking of sugar beets, Montana's crop progress report shows the entire sugar beet crop has been planted and 71% of the crop has emerged here in the state. Spring wheat planting is wrapping up as well, with an estimated 97% of the crop planted. Winter wheat was reported with 30% of the crop booted, ahead of the previous year pace of 26%. Winter wheat conditions were rated as 80% good to excellent, compared to 87% this time last year. As for winter wheat harvest in the South, Texas is at 32% complete for harvest, while Arkansas is at 14% harvested. We'll be right back. Today, U.S. agricultural exports in fiscal year 2020 are now expected to be valued at $136.5 billion. That's down from the $139 billion in February. COVID-19 being the main driver for those reductions, and bulk commodities including soybeans, cotton, corn, and wheat are making up the biggest portion of that decline. The forecast for wheat exports is down $300 million to $6.1 billion as larger global supplies and uncompetitive U.S. pricing reduce prospective volume. Livestock, poultry, and dairy exports are unchanged from the February projection of $32.4 billion, as stronger demand for pork and dairy products offsets a decline for beef and poultry products. Expanding on the decline of agriculture exports, China is halting imports of some U.S. agricultural products through state-run agriculture companies. The move comes as a response to tensions between the U.S. and China regarding Hong Kong. This action is the latest by China, which puts a trade agreement full of wins for U.S. agriculture in jeopardy. Last week, President Donald Trump threatened to punish China for its relations with Hong Kong. China responded by pausing purchases of U.S. ag products, including recent inquiries to purchase U.S. soybeans. China said the measures announced gravely interfere with China's internal affairs and undermine bilateral relations and will be detrimental to both sides. However, the retaliation is likely temporary, as China will need more soybeans, pork, and beef, among other products. China was increasing purchases of U.S. ag products as the nation reopens following the coronavirus pandemic, but at a slower than expected pace to fulfill the Phase 1 trade agreement. That's all for today.